Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Brookdale Senior Living Inc. Annual Report. Brookdale Senior Living Inc. offers a wide range of senior living services and accommodations through its three main segments: independent living, assisted living and memory care, and continuing care retirement communities, CCRCS. The company's services cater to seniors with varying levels of physical ability and healthcare needs. The independent living segment provides housing for middle to upper-income seniors in communities that offer independent and assisted living units. In contrast, the assisted living and memory care segment offers 24-hour assistance with daily activities for residents, including those with Alzheimer's and other dementias. This segment operates freestanding communities with various amenities. The CCRC segment is a comprehensive senior living solution that provides multiple levels of care, including independent and assisted living, memory care, and skilled nursing services. These communities offer various living arrangements to accommodate different healthcare needs. Additionally, Brookdale manages communities on behalf of others, further expanding its range of services. The surge in Brookdale Senior Living Inc.'s stock price by 176.85% in the past year can be attributed to several key events and factors. The company's announcement of strong preliminary results for 2025, with a 19% increase in adjusted EBITDA, was a significant catalyst. This was followed by optimistic guidance for 2026, projecting a further increase in revenue per available room, RevPAR, growth. Brookdale's Investor Day presentation highlighted its multi-year growth targets, emphasizing occupancy recovery and pricing discipline. The company also outlined its strategy to achieve a stabilized, consolidated footprint of 517 communities by mid-2026 through dispositions and lease renegotiations. This strategic update boosted investor confidence and contributed to the stock price increase. Consistent occupancy growth was another key factor driving Brookdale's stock price appreciation. The company demonstrated notable improvements in occupancy rates throughout the year, with a weighted average occupancy of 82.5% in September 2025, up from 79.2% in the same period the previous year. This trend signaled increased demand and positive operational momentum. The upgrade of several financial analysts' ratings and price targets for Brookdale's stock also contributed to its stock price increase. RBC Capital, BofA Securities, Barclays, and Zacks.com all upgraded their ratings or raised their price targets, citing an upward trend in earnings estimates and confidence in Brookdale's projected growth. Finally, Brookdale achieved positive adjusted free cash flow for the full year 2025, marking a significant milestone in its financial health and operational efficiency. These combined factors created a strong positive sentiment around Brookdale Senior Living Inc., leading to its substantial stock price appreciation over the past year. Brookdale Senior Living Inc. maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Brookdale Senior Living Inc. trades at a lower price-to-book ratio of -79.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 97% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a senior living community are multifaceted. Attracting and retaining top associates is crucial in enhancing resident experience and improving operations, leading to increased occupancy levels through targeted sales and marketing efforts. Effective controllable expense management and margin improvement also contribute significantly to revenue growth. Providing high-quality care and personalized service fosters trust and satisfaction among residents and their families, resulting in increased revenue. Acquisitions of senior living communities from Welltower Inc. have been a significant driver of revenue growth, with the purchase of 5 communities for $175 million and 11 communities for $300 million. Additionally, increases in annual minimum rent and escalators have contributed to revenue growth. Increases in resident fees and same-community RevPAR have also positively impacted revenue. On the other hand, several factors contribute to revenue decline. A decrease in the number of communities has led to a reduction in revenue. The shift in occupancy, mixed towards more independent living and assisted living residents, partially offsets revenue growth. Lower skilled nursing revenue also contributes to revenue decline. Furthermore, underperforming communities being disposed of and lower than expected occupancy at certain leased communities have negatively impacted revenue. The net income of the company experienced a mixed trend between 2023, 2024, and 2025. Initially, it increased by $12.9 million from 2023 to 2024. However, in 2025, there was a decrease of $60.8 million compared to 2024. On a more positive note, the net income did increase by 10.6% from $343 million in 2024 to $379.8 million in 2025. The profit margins of the company also underwent changes during this period. While there is no explicit statement on the change in profit margins, it can be inferred that they may have decreased due to asset impairment expenses and an increase in general and administrative expense. However, the successful execution of the healthcare strategy could have led to an increase in profit margins. The company's financial performance is a testament to its ability to generate positive operating cash flow. As evident from the data on page 47, the net cash provided by operating activities has shown a significant increase of 31.2% from $166,177,000 in 2024 to $218,030,000 in 2025. This substantial growth indicates that the company is efficiently managing its operations and generating sufficient cash flow to support its business activities. The positive trend in operating cash flow suggests that the company is on a stable financial footing, with the ability to invest in growth initiatives and meet its financial obligations. The company's debt level has undergone significant fluctuations over the past year. While some pages indicate no significant change, others reveal a substantial increase in long-term debt and lease obligations to $7,088.3 million as of December 31, 2025. Additionally, the total debt level increased significantly due to new financings, according to page 84. However, there are also instances where the debt level has decreased, such as on page 64, where a significant decrease in long-term debt is mentioned. Furthermore, page 81 reports that the total debt obligations decreased to $4,292.5 billion as of December 31, 2025, down from the previous year. Regarding interest expenses, there are also mixed signals. While some pages indicate an increase, such as page 23 and page 24, others report a decrease, like on page 65. The weighted average interest rate has remained relatively stable at 5.06% as of December 31, 2025, according to pages 48 and 81. It is worth noting that the company's debt level and interest expenses have been affected by various factors, including required lease payments, potential defaults under financing arrangements, cross-default provisions, new financings, and changes in interest rates. Management's primary goal is to establish the company as the nation's most trusted and effective senior living provider. To achieve this, they aim to drive value for residents, families, associates, and stockholders through operational excellence. The company expects long-term returns through organic growth in revenue per available room, RevPAR, adjusted earnings before interest, taxes, depreciation and amortization, adjusted EBITDA, and cash flow. The management plans to leverage the company's size and scale to realize cost savings and economies of scale in procurement and operations. They also intend to simplify the role of executive directors by focusing on residents and their families, attracting high-quality community leaders, and maximizing quality of care and operating efficiency through direct resident and associate interaction. In terms of growth strategy, management plans to sell 29 owned communities in 2026, generating approximately $200 million of proceeds. They also aim to reduce reliance on contract labor and overtime, while maintaining quality care and service by attracting and retaining top talent through competitive wages, benefits, and career development opportunities. The company's environmental remediation efforts may have an adverse effect on its financial condition, results of operations, and cash flow. Changes in environmental regulation could have a material adverse effect on the business. Management expects to fund business through historical principal sources of liquidity over longer term and anticipates paying a regular quarterly dividend in the future. Overall, management strategy is to deploy capital to fund planned capital expenditures or investments to support growth, while maintaining a strong focus on operational excellence and cost savings. The company has a history of paying dividends to its shareholders, although this practice was suspended indefinitely in December 2008. However, it is worth noting that there is currently no information provided on dividend payments. On the other hand, the company has been actively buying back shares from the market. According to available data, a total of 32,266 shares have been purchased at an approximate dollar value of $283,000 based on the average price paid per share. This indicates that the company is committed to reducing its outstanding share count and potentially increasing shareholder value through this strategy. There are concerns surrounding the stability of supply chains and inventory management. One potential issue is supply chain disruption, which could arise from shortages of labor or materials. This risk factor is specifically mentioned as a potential threat to capital projects. Furthermore, there may be signs of inventory buildup, indicated by changes in accounts receivable and trade accounts payable. These metrics suggest that companies may be holding onto more inventory than usual, potentially leading to inefficiencies and wasted resources. That concludes the financial summary for Brookdale Senior Living Inc. Feel free to comment below, and I will be happy to answer them when possible.